I feel like as a dollar tripper, one of the first places that you are ever going to notice a recession happening is in a spicy club. I think we're really in a recession.
That's Cody Rose. She's a stripper and self-proclaimed bop. And while we've covered how sex workers predict market crashes before on this channel, Cody has another, almost equally as interesting indicator that a recession could be lurking.
One of the most telltale signs that we are in a recession is, as a dancer, I used to constantly get asked by customers where they can hit the slopes in the club, if you know what I'm saying.
Oh, is she talking about customers doing cocaine?
Cocaine?
Yep, she definitely is. And just like we saw in our first video, we know what the culprit is to all this.
Which just goes to tell me they can't afford this shit anymore. I think we're really in a recession.
When consumers feel unsure about the future, their spending habits change. They stop buying things that are unnecessary. And strippers and blow definitely qualify as that. It's called discretionary spending. But how bad is it getting? Because she's not the only one noticing this trend. In this video, we'll go over the unconventional yet oddly effective recession indicator of strippers and cocaine. Then, since this is an investing channel, I'll give you some portfolio updates and where I'm looking next. If you want more content in your feed on intelligent investing, be sure to like and subscribe to this video. All right, let's get into it. We'll start with the strippers. It's not just Cody Rose who's ringing the alarm bell. Other sex workers are also seeing low customer turnout. The Austin-based stripper/social worker, who goes by Vulgar Vanity Online, said in a TikTok video back in 2022 that she could earn almost 6 figures a year by dancing at a handful of big events around Austin, like South by Southwest. And this year, she said she didn't even bother working the event because the first Friday she walked into the club, it was entirely empty. And that's wild because South by Southwest is a huge tech get-together. If there's anyone who should have discretionary spending, it's the tech bros. And this isn't contained just to the United States. This European sex worker and legal brothel owner, Catherine Denor, who also, by the way, is a PhD candidate in psychology, is also noticing a huge downturn. So sex workers both in the US and internationally are feeling the burn right now. But the most perplexing thing in all of this is that in terms of economic data, the economy's humming along surprisingly well right now. We just got our economic data for May, and non-farm payrolls jumped 139,000, and unemployment is holding steady at 4.2%. Which economists consider full employment. Paychecks are also growing faster than prices. Average hourly earnings rose 0.4% or 3.9% year over year. And the cherry on top, consumer confidence just leapt. The Conference Board Index jumped 12 points in May, the biggest monthly gain since 2021. And that's the tricky thing about the Stripper Index. It's an anecdotal indicator, but we can get some real data out of this. According to the Huffington Post, legal brothel revenues in Nevada are down 20% since last quarter. That's a huge drop for a single quarter. And that tracks with what we're hearing on the ground level. In Las Vegas, strip club revenue is down 12% year over year. So this is completely reminiscent of what we saw in 2008, when sex workers started sounding the alarm. We had really good economic data before everything went bad. In Q4 of 2007, unemployment was 4.8%, slightly above the current levels, but nothing to really bat an eye at. And this is really wild. Real GDP grew 4.9% in 2007. That is a great year for GDP. And consumer confidence was also rising during that time. It grew 2.6% in 2007. This is strikingly similar to today. The disconnect mostly lies in the fact that economic data is a lagging indicator, whereas sex workers on the ground reporting hardship is a leading indicator. And that's the problem with lagging indicators. They can be surprisingly strong until they're not. Speaking of something being really fun until it isn't, cocaine.
Cocaine's a hell of a drug.
The cocaine market is also a market that's really hurting right now. In an unexpected report, Colombia's cocaine producers are stuck with historic levels of unsold supply. And it's not because there's a mega trend where people are using the drug less. According to the World Drug Report, back in 2022, the global demand for cocaine had been growing at 20% year over year. That's wild. That's like what Microsoft grows at. And I don't think that there's a drug that better represents a very specific type of consumer. Cocaine is a premium drug. It's used by the upper crust consumer class. And we can validate this by looking at country usage rates, which fascinatingly are calculated by measuring sewage water. The country that has the most cocaine usage in the world is the UAE, which has a very high concentration of upper crust consumers. And North America represents almost a quarter of all cocaine users worldwide, with the US being the primary driver, right? We're the wealthiest economy. So all of this data, the strippers, the blow, paint a consistent picture that the upper crust is feeling a discretionary spending squeeze. People are still engaging in leisure and indulgence, but with a newfound caution, opting for cheaper alternatives or foregoing some splurges entirely. And it's really hard to encapsulate how important this consumer class is to the overall economy worldwide. A Moody's report found that almost 50% of all consumer spending comes from just 10% of income earners. And you can see the cracks forming around other areas of upper crust spending. Capri, which holds Versace, Michael Kors, and Jimmy Choo, is down 46% this year. And their revenue paints a consistent picture. It peaked right around 2022 and has gone precipitously down since then. And you can see that across their entire P&L. Net income's also down 416% in the last year. It's also impacting their balance sheet. And it's not just Capri's brands falling out of favor. This is extending through the entire luxury market. And it's also extending to other sectors that rely heavily on upper crust consumers. Bank of America is reporting that summer travel could be the worst that it's been since the pandemic, and they cite low consumer confidence as the reason why. So while the lagging economic data is showing that consumer confidence and paychecks are doing well, we're also seeing a very important class of consumer start to tighten their belts. And sex workers seem to once again be detecting it earlier than everyone else. As one analyst brilliantly put it, the earliest warnings come not from Wall Street, but from the street itself. So what am I doing about it? Well, frankly, I'm hoping that these sex workers are right. I'm hoping for a crash. And you should be too, because that's when the real money gets made, and our generation hasn't had a great opportunity. It's really hard to train yourself to be greedy when others are fearful. But if you know how to value companies, it becomes so much easier. You probably know that this iPhone's worth about $1,000. So if I was going to sell it to you for $500, it'd be a no-brainer to buy. But if you didn't know the value of it, and I tried to sell it to you for $2,000, I mean, I can talk to anyone in the world on it. It's a pretty cool device. And then the next day you saw that you could buy an iPhone for $800. Well, of course you'd want to panic sell because you think it's going to continue to go down. The same thing applies to the market. When you can value companies, you understand what they're worth, and you won't really bat an eye when they go down. Charlie Munger once said, if you can't handle a 50% drop, you deserve a mediocre result. I guarantee you that another crash will happen eventually, and we will be able to buy wonderful companies at great prices. Remember, the stock market is the only store where when everything goes on sale, everyone runs out of the store. In the portfolio that I've made public, I have a decent bit of T-bills ready to deploy whenever I find an opportunity. And when the fear around tariffs started dragging the market down, I finally got a chance to buy a new stock. I started building a position in Robinhood on March 27th, but then the price exploded. It's up 80% since I bought it. I laid out my entire thesis on flankinvesting.com, and you can find it there if you want to see how I assessed the fair value and how I derived it. Now, if the stock would have gone down instead of skyrocketing up, I would have bought more. I was really confident in this one, but the price got away from me really quick. And right now at its current price of $72 a share, it's getting closer and closer with my margin of safety to what I think the intrinsic value is. So I'm not adding to the position right now, but I'm hoping that it comes crashing down soon. But I knew all this because I did my research. Actually, I didn't do all my research. I did 46% of my research. But honestly, that 46%, I guarantee you that I know more about Robinhood than 99% of people. And that's by doing just half of the flank research steps. That's the power of researching businesses and keeping track of your research. You can do all of this, as well as join a community of other intelligent investors by checking out flankinvesting.com. It's free to get started. If you're interested, there will be a link in the description below. And don't worry, if the thought of doing deep research seems so daunting to you right now, we have a pretty cool course that's free. I've read every single word that Buffett has written since 1965, and I distilled it into about a 2.5-hour course. So if you want, you can check that out. So where else am I hunting right now? Well, there was a Barron's article that came out talking about all the Berkshire wannabes that are coming up since Buffett announced his retirement. And I published due diligence on Flank for the companies that were mentioned in that article. And while a lot of companies sat outside of my circle of competence, there was one that I thought was really interesting, and that's Loews Corp. The CEO spot just got handed to Ben Tisch, who's 46 years old, and he seems to have some really good plans to grow the company. He opens his first letter to shareholders by saying, like my father and his father before him, I believe the CEO of Loews Corporation has one job, and one job only: to grow intrinsic value per share. Oh, I love that statement. And the company has some really interesting things. They own 92% of CNA Financial, which does commercial property and casualty insurance, similar to Berkshire, and 100% ownership of Boardwalk Pipelines, which does natural gas pipeline and storage. And then, as the name suggests, they also own 100% of the Loews hotel chain, which has 25 properties and 16,000 rooms. There's a lot of growth potential there. So yeah, I like this company. You can check basically any factor, and it looks like a good buy. They're doing tons of share buybacks, free cash flow is doing great, revenue's been on a steady growth for the last 2 years, and they have a really good net profit margin of around 8%. So yeah, I'm going to be diving deeper into Loews Corp. But for now, that's all for this one. Thanks so much for watching. You'll see our first video on how sex workers predict market crashes over my shoulder now. In that video, we went deeper into the economics of anecdotal indicators. So it's definitely worth a watch if you're interested. Thanks again, and we'll see you in the next one.